Good evening, ladies and gentlemen, and welcome to today's iteration of the Possible Worlds lecture series with Professor Gabriel Zucman from our sister campus to the north, UC Berkeley. I'm David Scholar, Dean of the Division of Humanities at UCLA and Senior Dean of the College of Letters and Science. And I very briefly want to speak about the Possible Worlds lecture series itself. This is a partnership between UCLA, specifically the Division of Humanities at UCLA, and the Berggruen Institute, which is a very important, I'm not quite sure how to characterize it, think tank, intense space for interaction, a place where fellows and permanent members of the Institute interact very intensely around a number of subjects that all have to do basically with the future of humanity and with ways of thinking about the future of humanity. That's our territory too, in the Division of Humanities at UCLA. We're really proud to have this partnership. Past speakers in the series included philosopher Daniel Allen, architect Alejandro Aravena. We had Kim Stanley Robinson, the novelist, and we had Daria Isaksson, the Director General of Vinnova, the Swedish innovation agency. To introduce more about the Institute and about the Possible World Series, I'd like to introduce Nils Gilman, who is Senior Vice President of Programs at Berggruen Institute. Nils.
Thank you so much, David. Thanks, David, and thank you all for coming here this evening. And for those of you who are online, thank you for joining us that way. So the Berggruen Institute's mission is to develop foundational ideas for reshaping the political and social institutions that we need to in the face of the great transformations that the world is undergoing today. I think everybody can recognize what those great transformations are. We're in a time of dramatic change in politics, in culture, and in the environment, and we need new institutions who are thinking about that. One of the reasons why we want to do the Possible Worlds and been partnering with UCLA to do this Possible World series is we want to bring in thinkers to UCLA and to Los Angeles who are doing really innovative thinking about how we can reshape our institutions in the face of these great transformations. Tonight, we have the honor of welcoming an old friend of mine, Gabriel Zucman, who's Associate Professor of Economics at UC Berkeley and Director of the James M. and Kathleen D. Stone Center on Wealth and Income Inequality. He also serves as the Director of the EU Tax Observatory, which is an independent research laboratory hosted at the Paris School of Economics. Zucman's research focuses on accumulation, distribution, and taxation of global wealth, and has renewed the analysis of microeconomic and distributional implications of globalization. One of the great transformations we've been undergoing for the last 40 years, obviously, is the great growth in inequality in nations around the world and the political consequences of that. And Professor Zucman's work speaks very directly to how we might address some of the challenges that have emerged in that way. Zucman's also been named Andrew Carnegie Fellow and Sloan Research Fellow and has received the Bannister Prize, the Excellence Award in Global Economic Affairs from the Kiel Institute of the World Economy, and the Best Young French Economist Prize from Le Monde and the Cercle des Économistes. And now I'll turn it back over to David to introduce the next program.
So here's how tonight's program will work. After Professor Zucman's remarks, we'll have a Q&A session here. And for that Q&A session, we're happy to welcome our UCLA colleague, Professor Juliana Londoño-Vélez from the Department of Economics here. Juliana is an assistant professor in the department and a faculty research fellow at the National Bureau of Economic Research. During this part of the program, that is during the Q&A, we welcome questions from the audience here in the room and the audience online. Now I'd like to welcome Gabriel Zucman.
Thank you so much, David. Thank you, Niels. Thanks to all of you for being here. It's a great pleasure to talk tonight about the new Treaties of Globalization. And I like to say at the outset that I'm going to talk about taxes, which one may not think of as the most sexy topic on earth, but I really think taxes are important. Let me just preface by saying that we live in societies where the government takes 30%, 40%, 50% in many European countries of income in taxes each year. That's the tax to income ratio, the tax to GDP ratio in high income economies. So think of our modern societies as societies where government takes almost half of everything that's produced and earned in a given year and redistributes half of everything that's produced and earned in a given year. And so kind of thinking about how we do that, this taxation, this redistribution, is perhaps the most important question that we face as citizens, as voters. It is, in my view, one of the most important, not only policy and political question, but also the most philosophical question. How should we organize taxes is how should we organize society and living together. All right, so that being said, let me start by saying that we live in tax systems today that you could call, or you could say, our brain children of the 1950s. So what does it mean? It means that in most countries, and if you take the world as a whole, half of all taxes, half of all tax revenues come from just two forms of taxation: value-added taxes, which are taxes on consumption, and payroll taxes, which are taxes on wage income, like social security taxes in the US. Value-added taxes, consumption taxes, that form of consumption taxation was invented in the 1950s in France. It's one of these great French inventions that French people are very proud of, and one of these great French exports. France experimented with value-added taxes in the 60s, and then it caught fire, and essentially all the world's countries, with the exception of the US, but essentially all other countries adopted their own value-added tax. Payroll taxes were not invented in the 50s, but just before, and they were small until the 1960s, 1970s. They grew very fast with the growth of social security systems, pension systems, healthcare, and so on. And the two characteristics of these two taxes is that they are flat taxes, so everybody pays the same tax rate, no matter what your income or your wealth or your consumption might be. And there are taxes on consumption for the value-added tax, and on labor income and wage income for payroll taxes. And basing your tax system fundamentally on those taxes could be justified in the post-World War II European context, when, number one, capital was very scarce. It was after World War II, there had been lots of war destructions. Policymakers wanted to encourage saving, building back the capital stock. Having more capital in the economy is a good thing, it makes workers more productive. And so the idea of just taxing consumption, not taxing saving, which is what consumption taxes like the VAT do, just taxing consumption, exempting saving, made a lot of sense at the time. Number two, in those post-World War II decades, the labor share was high, meaning, out of any dollar or euro of value created by a company, a relatively big fraction of that went to workers, and a relatively low fraction went to firm owners, to capital owners. And so in that context, it's a context that corresponds to strong union power, more generally speaking, a relatively high bargaining power for labor relative to capital. In that context, it made sense to fund the social state, meaning the social security system, retirement, healthcare, primarily through payroll taxes. And flat tax rates were not a major issue in those decades when income and wealth inequality was at a relatively low level. You have to think of the 50s, 60s, 70s as the historical nadir for income and wealth inequality in Europe and in the US. So all of that made sense at the time, but today's context is really different from the 1950s. It's really the opposite. Today we live in societies where capital is back, so to speak, meaning capital stocks are very big compared to the size of the economy. If you look at a very simple statistic, which is just the ratio between the amount of household wealth in the economy, the value of everything, houses, equities, bonds, bank accounts that people own, relative to GDP, which is the value of everything that's produced, the flow of goods and services that's produced in a given year, that ratio was around 200% just after World War II in the US, in Europe, meaning wealth was the equivalent of 2 years of income in total in those countries. And today the ratio is closer to 600%. Just wealth is very, very big. We see this these days with very high housing prices, with the secular rise in equity prices, even though they've been falling since the beginning of the year. But just wealth is very big compared to wages, compared to income. The capital share, which is a fraction of firms' output that goes to capital owners, to firm owners, has been rising, and the labor share has been falling. And of course, inequality has been rising globally, particularly fast in countries like the US, China, India. And so the gist of my remarks is that we need to invent 21st century tax systems that are going to be adapted to the inequality challenges of today. Now, the problem when you say that is there's a widespread view that progressive taxation, meaning taxing the rich at a higher rate than less wealthy individuals, and capital taxation cannot work in a globalized world because of tax competition, because of tax avoidance, because of tax evasion. This idea that in such a globalized world, you cannot tax multinational firms, you cannot tax rich individuals because they would move to relatively low tax places. And what I want you to understand is that this view fundamentally is not correct. It's not correct because tax competition, tax evasion, tax avoidance, they are not laws of nature. They are not things that exist like stars in the sky. They are policy choices. As nations, as communities, we choose to allow, to tolerate, sometimes to encourage tax competition, or we could choose coordination, harmonization, and so on. And the choices that we've made since the 1980s have been choices that have encouraged tax competition, but those choices were not very transparently, in my view, or not very democratically debated. The important point, however, is that there are choices nonetheless, and we can make other choices. Okay, so to put it differently, the current form of globalization that we have is just one among many other potential forms of globalization. And so what I'm interested in discussing tonight is, concretely, what are these other forms of globalization that could emerge and that could allow to reconcile international economic integration on the one hand with tax progressivity, tax justice on the other hand. Now, one very clear indication that other forms of globalization are possible is that there's already been some progress over the last decade in the sense that new forms of international coordination have emerged or are emerging. Most importantly, I'm sure many of you have heard about it, there is the prospect, very serious prospect these days of an agreement on a global minimum corporate tax of 15%, meaning multinational companies should have to pay at least 15% in taxes no matter where they operate. And that's a really important development because it would be, if it became a reality, it would be the first time that there would be an international agreement, an international treaty that puts a floor to how low taxes can go, tax rates. It would be the first time that we have a common tax rate. And the second thing that has happened is, over the last decade, there's been the emergence of a new form of international cooperation, which is what you could call the end of bank secrecy. 10, 15 years ago, it was really easy for wealthy people to hide assets in places with very strict bank secrecy rules, Switzerland, Cayman Islands, places like that. And since 2017, 2018, the financial institutions in those countries are supposed to automatically send information to other countries' tax authorities about their clients. So that's a big change. But what I want to say today is that, obviously much more is needed. So what is needed? To understand what is needed, I'm going to talk first about what do we need to do to address one, in my view, very important problem that the world faces today, which is international tax competition and global profit shifting. So let me just explain a little bit the nature of the problem that we face today. So if we look at the data that exists on this issue, the best estimates that are available suggest that close to 40% of multinational profits are shifted to tax havens each year globally. So what does it mean? Multinational profits, these are profits made by companies outside of the country where they are headquartered. So think about the profits made by Apple outside of the US, or BMW outside of Germany. If you look at the world as a whole, about 40% of that total each year, so that's around $1 trillion today, $1 trillion is in profits are booked in places like Bermuda, like the Cayman Islands, Ireland, and similar zero tax or low tax countries. A very concrete example, in 2019, Alphabet disclosed that they had made $24 billion in revenue in Bermuda, where the corporate tax rate is a relatively modest tax rate of 0%, and where nothing of substance happens, but they say, they disclose it, we're just making 24 billion in revenue in that place where we pay a zero tax rate. And so globally, the problem is very big, and we can know that the problem is large, and we can quantify the size of this profit shifting by looking at the difference in profitability between foreign firms and local firms in tax havens. What does it mean? You take Ireland, for instance, and you compare the profitability of local Irish firms, which are not part of a multinational group, and companies in Ireland that are part of a multinational company, like subsidiaries of Apple in Ireland or subsidiaries of Alphabet in Ireland. And in local firms, if you look at the ratio of profits divided by wages, it's around 50%, meaning for any euro of wage that a regular Irish company pays to its workers is going to record 50 cents in profit. But if you look at foreign firms, affiliates of foreign multinational companies operating in Ireland, on average for any euro of wage that they pay, they claim that they make 8 euros in profit. So it looks like they're extremely profitable for the very simple reason that the multinational firms can stuff those subsidiaries with all the profits that they can shift into those places. And so what the graph shows is that in a number of relatively low tax places, this profit to wage ratio within subsidiaries of multinational companies is really extremely high. And these are also the places, this is what this graph here shows, these are also the places where the effective corporate tax rate is very low. So what we usually call tax havens, meaning the effective tax rate is typically around 5–10%, in places like Ireland, Puerto Rico, which is not subject to the federal corporate tax, Panama, Malta, Bermuda, 0%, and so on and so on. And just to give a bit more texture on what's happening in terms of profit shifting, I'm sure many of you know that there was a big tax reform in 2018 with a big cut in the US, with a big cut in the corporate income tax rate from 35% to 21%. And this reform also introduced provisions to limit profit shifting by US multinational companies. And so at the time, the proponents of this bill said, look, it's going to be effective at reducing this form of tax avoidance by multinational firms. If we tax our companies less, and if we make it harder for our US companies to do profits in Bermuda, in Ireland, then they're going to stop doing that, right? But what the graph shows is that, in fact, not much has happened. That is, if you look at all the profits made by all US firms, no matter whether they have operations outside of the US or whether they are just small US mom and pop shops, on average, around 15%, 14–15% of their profits, their total global profits, are booked in tax havens, primarily in Ireland, Switzerland, Caribbean islands, and so on. And this has declined a little bit since 2018, but really not much has happened, especially relative to the big increase that has taken place in the 1980s. So we are in that situation today where there's been this upsurge in tax avoidance by multinational firms, and there's no sign that this is declining. A last element of context is that we are very much engaged as nations into this race to the bottom with corporate income tax rates. This is a graph that shows the corporate tax rate that has been applied historically in the US, on average in African economies, Latin America, Asia, EU, the OECD, the world as a whole. And the trend is really dramatic, right? The world average corporate income tax rate in the 1980s was around 40%. Today it's getting close to 20%. So it's almost been divided by a factor of 2 in 40 years. That's what people call the race to the bottom. If the trend continues at that pace in 2060, there won't be a corporate tax anymore. The rate will be 0%. And we can discuss, the pros and cons of such policy. Personally, the evidence, my reading of the evidence is that it would likely be a big engine for inequality. It would boost income and wealth inequality dramatically. But the point is, this race to the bottom is raging, and the US tax reform that cut the rate from 35 to 21% in 2018 kind of put additional fuel on this fire. All right, so let me talk a little bit about the way forward. I alluded to the prospect for this global agreement on a minimum tax of 15%. And I want to say that, again, reiterate that I think it's a major achievement, it's real progress, but also it is flawed and insufficient in critical ways. And if we try to think a little bit about why, I think the problem is that when these types of agreements are negotiated here under the auspices of the OECD, we insist, or the OECD insists on reaching a consensus, on unanimity. Now, if you start negotiating agreements like that by insisting on consensus and unanimity, you're going to give enormous blocking power to the many countries and territories that benefit from the current status quo, that benefit from tax competition, that attract all those profits from abroad. So you're going to give a lot of power to tax havens. And in fact, when we think about what has happened over the last few years, I think the process that's been implemented, in effect, has given more power to countries like Ireland, or even the Cayman Islands, or Hungary, which is, at the moment blocking the agreement within the European Union, 27 member states in the EU, and any country can block any common EU tax policy. And so today we are in a situation where Hungary, just one country, blocks the implementation of this agreement within the EU. We're giving much more power to those countries than to countries like Brazil, like South Africa, like India. And that doesn't seem like a very rational way to proceed if we want to reach ambitious agreements. And so I think the way forward here is to just think differently. If we want to make progress, the future is not in starting from unanimity and consensus, but more starting with unilateral action, or multilateral action with coalition of countries, could be 1, 2, 3 countries, moving alone with ambitious forms of coordination. So very concretely, it could be the US that could say, and it was, for instance, in President Biden's presidential program, there was this idea of a 21% minimum tax, global minimum tax. The US could have said, look, we're going to have an agreement with 21%, and the countries that want to do this, to have this 21% rate, can do it with us, but we are not going to wait on the approval of Hungary or the Cayman Islands before we do that. And it seems to me that this is the way to go. And after having studied these issues for a long time, I've come to the conclusion that, in fact, a lot of progress can be done, can solve almost all the problems with unilateral action by a number of countries, especially big countries like the US, but even a few countries in Europe or in Asia. And I want to emphasize and I want to stress that point because it's something that's not, in my view, well understood. The kind of prevailing view is that no progress is possible until all countries agree. You can't have a global wealth tax unless all countries have a global wealth tax because people will move. to whatever country doesn't apply the tax. Same for corporate taxation. But in fact, that's not true. You know, it's very simply quite wrong. For instance, what could be done is for any company in the world. Let me take a very concrete example. For any company in the world, let's say the US wants to be ambitious, wants to increase the taxation of corporate profits. So the US could say for any company, we are going to compute what you could call the company's tax deficit, meaning the difference between what this company currently pays in taxes and what it would have to pay if it was subject to some minimum tax rate, let's say 25%, 30% if we want to be very ambitious, to a certain tax rate, country by country. Okay, for any firm, we can make that computation. So for instance, when Google makes 20 billion in Bermuda, there's a big tax deficit here. Let's say 30% times 20 billion, that's 6 billion. Okay, that's a tax deficit. And any country could then decide to collect this tax deficit. The current system is a system where there's no tax collector of last resort, so to speak. When a company has booked profits in Bermuda, taxed at zero, that's the end of it. No country is going to try to tax those profits. And my argument is, well, of course we could do differently. We could have countries playing the role of tax collector of last resort. Meaning if some nations, if some countries, if some territories have decided to implement very low tax rates, even zero tax rates, why not? That's their choice, okay. But we are going to collect the taxes that they choose not to collect, especially if those firms that benefit from the very low tax rates benefit from our markets, you know, have customers in the US. It could be done by Japan, by the European Union, by India. Any country could do that. And it could really change the dynamic in the face of globalization, because once you start doing that, once one country or a small group of countries start to play this role of tax collector of last resort, it would create a dynamic where those countries would start collecting a lot of tax, and the taxes that tax havens choose not to collect. And so what would happen is that other countries at some point would be tempted to do it, and when sufficiently many countries do that, it would become pointless for firms to book income, to book profits in low tax places, because the low taxes paid there, in the Cayman Islands and Bermuda, would be offset by extra taxes owed in the US and whatever countries are part of this coalition. And once it becomes pointless for firms to book profits in tax havens, it would become pointless for tax havens to offer low tax rates in the first place. And so you would see those countries increasing their tax rate. And so you see how, you know, something that seems very technical, a bit boring, you know, collecting the tax deficit of multinational firms, in fact can have very profound effects on the nature of globalization. Can revert the race to the bottom, replace the race to the bottom with corporate income tax rates by a race to the top. And with a process that starts with just some political will in one country or two countries or a small group of countries. Okay, so that's just one idea for you. I'm talking a lot, and so I want to make sure, and we can talk about offshore wealth more in the Q&As, but I really want to talk about taxing wealth. I've done a lot of work, maybe too much, maybe I'm too obsessed by that topic, but I think it's really important. The starting point here is that most countries tax wealth in the sense that they tax real estate, which is the main form of wealth for most people, for the middle class. But most countries also do not tax financial assets, which account for the bulk of wealth for the very rich, which are concentrated at the top. So to summarize, today in the US, in most countries throughout the world, we have very regressive, archaic, and pretty large wealth taxes, namely property taxes. And many people are content with that, but it's clear that we could do better. We could do better by taxing all of net wealth instead of just taxing real estate. You know, why not tax financial assets, net of debts, instead of having a flat tax rate, which is what the property tax is, the tax rate just depends on the value of the home or something that's in fact very loosely related to the value, like in California with Prop 13. But instead of having the same tax rate, we could have graduated tax rates where very wealthy individuals would pay a higher tax rate than middle-class individuals. A number of countries, especially in Europe, but not only, have had such progressive taxes on net wealth in the past. France is one example, Germany, Denmark, Sweden, Norway, Spain, many countries. But those taxes, think about it, were based on just self-reported wealth information with almost no verification or enforcement by the tax authority, which of course made it possible for people to avoid the tax or to evade the tax in many ways. But nowadays, in 2022, governments have a lot of information about your income, but also about your wealth, and they could use that information to send pre-populated wealth tax returns to very wealthy individuals. Like, okay, based on the information that we have, we know you own this mansion and this portfolio of stocks and this company, and so we think your net worth is $100 million. And so based on that, here's how much you have to pay. That would make tax evasion much harder than in the past. And also, and that's related to what I mentioned earlier, since 2017-2018, there is this automatic exchange of bank information, where tax authorities receive information from Swiss banks, banks in the Cayman Islands, and so on. And so making tax evasion much harder than in the past. Why do we need to do that? We need to do that because if you look at our tax systems in the US and all over the world, they do a very poor job at taxing the ultra-wealthy. Meaning, if you compute effective tax rates across the income distribution, so you rank people by their income, and you compute how much taxes they pay, including all taxes, payroll taxes, individual income taxes, sales taxes, whatever, property taxes. You add up everything and you divide by their income. That's the total effective tax rate for each group of the population. In the US, pretty much all the groups of the population pay around 27-28% of their income on average in taxes, all taxes included, except essentially billionaires who pay around 16-17% of their income in taxes. That's what is called a regressive tax system, where the truly wealthy, the wealthiest people in the country, have a significantly lower tax rate than the rest of the population. And that's, of course, a very powerful engine for inequality. It fuels income and wealth concentration. And the simplest, the most powerful, the most rational way to address that problem is to have a tax directly on wealth, starting perhaps with the wealth of billionaires. Now, when you say that, there's this widespread view that it's very hard to tax wealth in the globalized world, but very quickly I think the issues that are raised can be addressed, tax competition can be addressed by taxing non-residents. So for instance, the US already does that to some extent, meaning if you're a US national, you have to pay taxes in the US no matter where you live. European countries, almost no other country does that, but they could have some form of taxation of non-residents, by which I mean if you've been a tax resident in, let's say, France for 40 years, and you've become a billionaire in France, that's great, it's good for you, but it's in part because you've benefited from French infrastructure and public goods and services, and so there's no natural right to then leave the country, go to Monaco or to whatever, Switzerland, and stop paying any tax in France. Because France could say, we're going to keep taxing you for 5 or 10 years, number of years that can depend on the number of years that you've been a tax resident in France in the first place. That's a choice that could be made. That's not made currently, but of course we could do that. We could address tax evasion, we could address the classic issue of how to value private businesses. Okay, and let me just conclude by saying that we need new instruments, we need new forms of international cooperation, and we need new institutions to address the challenges of today. Beyond the automatic exchange of bank information that exists since 2017-2018, in some of my work I've made the case for what you could call a global asset registry. And here the idea is we have real estate and land registries in the US, in most countries, and those registries have existed for a very long time. In France, it was created by the French Revolution in 1792. In the US, they were created in the 19th century most of the time. They are public. You can usually go on some website and type in any address in New York and see who owns a certain piece of real estate, or type any name. And so we already publicly record the ownership of wealth for one specific form of wealth, which is land and real estate. Why not do that for other forms of wealth that have become very big since the 19th century, so financial assets? Beyond the minimum tax that I discussed, I think we need to take much more seriously the interests of developing countries, which today are not taken into account, much less than the interest of tax havens. And I've emphasized that escaping from the straitjacket of unanimity, the way to make progress in the near term is with unilateral and multilateral action. So thank you very much, and I look forward to the discussion.
Okay, great. So my name is Juliana. I'm an assistant professor here at UCLA in the Department of Economics. And we have 15 minutes for Q&A. While you think of your questions, I'll start off with some of my own. Gabriel, in today's presentation, you talked about how in order to enforce wealth taxes, it's important to regulate suppliers. And some of your research shows that recent efforts by some developing countries to introduce the OECD transfer pricing standards to reduce multinational corporations' transfers to low tax jurisdictions, they were ineffective. You find that the policy did not raise tax payments, it only raises advisory services. And so clearly we know that tax advisors matter a lot, and such is the conclusion by other scholars, including sociologist Brooke Harrington. And so how do you propose that we regulate tax advisors? What would that look like in practice?
Thanks so much, Juliana. I should start by, first of all, thanking you a lot for doing this. And we've known each other for a long time. Juliana is a former graduate student of Berkeley, and she does absolutely essential research on taxation in developing countries. She studied wealth taxation in Colombia in particular. And so thanks a lot for doing that. We're very lucky to have you tonight. To answer the question, so the question, I've studied tax evasion a lot in my research, and one thing I think I've understood is that if you want to understand tax evasion, the reason why people evade taxes, especially rich people, is not that they wake up one day and they're like, I hate taxes and I need to stop paying taxes. I'm fed up with the government. And it's not. There is some of that, it can happen, but it's not primarily the demand that counts. What really matters is not the supply of tax evasion services. So you have to look at the industry of financial companies, banks, other financial intermediaries, legal intermediaries that sell not outright tax evasion or tax fraud, but tax avoidance services, which sometimes can be conducive of evasion and fraud. And that industry has grown a lot since the 1980s, and its size changes over time enormously, in particular because social norms change a lot. Like in the 60s, 70s, it was not considered a good thing for a company CEO to try to minimize tax payments. It was not considered part of the job. The prevailing view was that what a CEO should do is, the CEO was responsible to various stakeholders, to workers, government, paying taxes was part of the job, the responsibility of the CEO of the firm, responsible to shareholders, but not only and exclusively to shareholders. Now, these days the view is very different. It's the job of the CEO is to maximize profits for shareholders, and avoiding taxes, minimizing taxes, that maximizes income for shareholders, and so that's part of the job. And so we live today in societies where there is this big industry of tax planning, tax avoidance services, and if we don't regulate it, then I think it's going to be hard to make very big progress in terms of fighting tax avoidance, fighting tax evasion. And so you have all sorts of regulations that I've studied in some of my work that Juliana alluded to, where you force firms to disclose more information, for instance. But because the industry is not regulated, what happens is just those regulations create more business for the tax advisors, for the tax planning industry. And so if you really want to curb tax avoidance, tax evasion, you need to shrink the size of that industry. And how can you do that in practice? Well, you can have bigger sanctions for non-compliance, for when these firms help their clients evade taxes. And they do it all the time in the sense that one thing that's important to understand is that in the tax law of essentially all countries, there is a provision that says that if a given transaction is conducted with the sole purpose of avoiding taxes, it's illegal. It's known as the economic substance doctrine, and it's a kind of general anti-avoidance rule. And what those tax advising firms do is that they create such transactions kind of frequently, the stuff that has no commercial or economic substance, but that's going to help the firm pay less in taxes. And if the economic substance doctrine was strongly enforced, those firms could be charged with facilitating tax evasion, you could have higher penalties, and you could reduce tax evasion quite dramatically.
Thank you. Yes.
Well, I have a question. To what extent, if it would replacing let's say the pre-Trump corporate tax rate or higher, without also doing all of that other stuff to become like the tax collector of last resort or whatever, how much of that will actually increase revenues?
That's a good question. So your question is, okay, if we get back to the 30% tax rate that was enforced before the Trump tax reform, would we actually get more tax revenue? And the answer, I think, pretty clearly is yes, in the sense that if we look at what has happened to corporate tax revenues since the Trump tax reform, there's been a decline by about 30–40%, in line with the decline in the tax rate. And when you move from 35 to 21, you reduce the tax rate by 30–40%, and revenues have fallen in proportion. And so I think, realistically, if we get back to 35%, we would get back to the pre-Trump level of tax revenues, which was itself too low, because even though the rate was higher, there was a lot of tax avoidance, there was a lot of profit shifting, and so I think the goal should be not just to return to the 2017 situation, but something that's going to be more sustainable in the long run, where you address these profit shifting problems that I've tried to quantify.
Yes, please.
So I have a question. I'm curious to know if there's any research or what is known about kind of this tax deficit. So let's say that 29 billion in Bermuda. What happens to it in terms of, is any of it redeployed as part of, to increase productive capacity in, let's say, in key markets like the US? How much of it goes to philanthropy? How much of it goes to dividends, the shareholders? Do we have data or research on that?
Yeah, that's a really good question. So sometimes people have the view that this cash is kind of trapped in Bermuda and not used for productive purpose. And that's often an argument that's used for giving some kind of tax amnesty to multinational firms, to encourage them to repatriate, these piles of cash that they've accumulated in tax havens. It's a nice story, but it's not quite true, because the cash is not in any meaningful sense in Bermuda. In some paper, in some document, it's registered as being in a subsidiary that's incorporated in Bermuda or in Ireland or somewhere between Ireland and Bermuda, sometimes in stateless entities. But the money is, for all intents and purposes, is available for the firm to deploy, for investments and dividend payments and share buybacks. And typically, most of it is used, most of these saving, from profit, tax saving out of profits shifted to tax havens, are used to pay dividends, have been used over the last few years to pay dividends or to do share buybacks.
Thank you.
Yes.
So a very well-known stylized fact is that in theory, the average American is more quote-unquote wealthy than the average German. And that's simply because the average American happens to own, well, say 40 to 90% of the income distribution in the United States happens to own their own home. But in practice, that doesn't mean anything because you can't really eat your home or you can't eat business equity, right? So the kind of question I have, and it is devil's advocate, is why focus on something as illiquid and as hard to evaluate as wealth as your target tax, when maybe it would be easier to just target tax flows like capital gains or borrowing, right? Very wealthy individuals usually borrow against illiquid assets. Why don't we tax that as income?
Yeah, that's a very good question. And okay, let me try to address it, really heads on. So, why do we care about wealth? We care for the following reason. For most people, wealth, what is wealth? Wealth is safety, security. You own your house, you own savings in a bank account, or retirement wealth, provides you with safety. For the very rich, wealth is not safety. They don't accumulate, hundreds of millions or billions, for precautionary saving monies, like economists would say. For the very rich, wealth is power. It's the power to influence policy. It's the power to influence the prevailing ideology. It's the power to influence the marketplace, by buying new entrants. So an extreme concentration of wealth means an extreme concentration of power. It's something that's very well understood in this country, in the US. That's something that's, to some extent, the root of the American Revolution, which is at least partly a reaction against what was viewed at the time as the excessively unequal, oligarchic aristocracies of the European continent. And there was this idea during the American Revolution of, we want to build a country that's going to be the opposite of that. And that an extreme concentration of wealth is not going to be compatible with a republic and with a democratic process. And so that's the reason, I think, fundamentally why we care. And I don't want to say that's the reason also you don't want to replace the income tax by wealth tax. The wealth tax serves a very specific purpose, which is really to tax the super wealthy correctly. To ensure at least that they don't pay less than the rest of the population, that you put limits to the process of wealth accumulation at the very top of the distribution.
Sorry. Thank you so much for tonight's talk, Professor. Just a quick question on what your thoughts are in terms of making some of your ideas into policy, especially when I think things politically feel so divided and global order seems to be fracturing in real time. Yeah.
here's what I would say. I'd say that sometimes it looks like the political situation is completely blocked and nothing will happen and all of that is pointless. And I sometimes share that sentiment. And when I want to give me a bit of hope, I look at history, especially I think U.S. history, which I've studied a little bit. Tax history, I think, is fascinating because it's full of U-turns and sharp reversals and stuff that happens sometimes in a relatively brief period of time. So let me give two examples. In the late 19th century, there is a debate about creating a federal income tax. And people see rising inequality, rising concentration of wealth during the Gilded Age, and market concentration, and they want to create a progressive income tax. But the Supreme Court, extremely conservative, rules that an income tax, a federal income tax, would be unconstitutional. That's in 1896 or 1897. However, in 1913, which is not long, it depends on how you view that, but it's just 16 years after, the US creates a federal income tax. The Constitution is changed, the US creates a federal income tax, and not only creates a federal income tax, but the rate increases from 0% in 1912 to 70% in 1917. So you move in less than 20 years from there will never in this country be an income tax because it's unconstitutional to we are taxing the rich at a rate of 70% on their income. That's example number one. Example number two, and you might say, well, it's World War I. It's a very specific context of a world war. Now let me give another example that's not in the war context, but it's going in the opposite direction, unfortunately. In 1980, just before Reagan enters the White House, the top marginal income tax rate in the US is 70%, like in 1970, which at the time is the highest tax rate of the rich among all industrialized countries in the world. And then in 1986, so just 5 years in the Reagan presidency, this tax rate is reduced to 28%, which at the time, in 1986, is the lowest tax rate among all industrialized countries. So in 5 years, we move from a very progressive tax system to a much less progressive tax system. So, stuff happens, and sometimes quite fast. Third example. Third example. When I started my PhD in 2009, it was largely on issues of tax evasion, offshore wealth, and at the time there was no exchange of bank information between countries. Essentially almost nothing, so it was really child's play for people to hide assets in tax havens. And at the time it seemed obvious to me, to many other people, that there should be this automatic exchange of bank information, just like regular banks within the US that send information to the IRS every year. But when you said, oh, Switzerland should send its information to the US or to France, people looked at you and they said, that's crazy, it will never happen. How on earth, could you force them? If they want to have very strict bank secrecy laws, that's their right, and there's nothing that can possibly be done to change that. I remember very well. And, now it's very different. And I'm not saying that, that all the bankers in these offshore financial institutions perfectly comply with the regulations and so on. It would be very naive. But just in terms of the law, the regulation, there's been a really dramatic evolution in just a few years. And so it illustrates that sometimes new forms of international cooperation can emerge that were thought to be perfectly utopian, can emerge in a relatively short period of time. That's what makes me optimistic.
Thank you.
Different question here. Yes, there seems to be something almost paradoxical about the tax haven situation, where a few countries have these very low tax rates. If it's not a very good deal, why are they doing it? And if it is a good deal, why aren't more countries doing it?
Yes, that's a very good question. So I think, and it's important to realize that a number of countries do benefit a lot from international tax competition and profit shifting and the race to the bottom with corporate tax rates. They benefit a lot in a variety of ways, but one figure that which is quite incredible to me is if you look at Ireland. Ireland has predicated part of its development model on offering a low corporate tax rate of 12.5%, and in practice, effective rates that are even lower than that, more like 5-6%. And if you look at the amount of tax revenues that they collect, they in fact collect an enormous amount of tax revenue with these low rates. That is, if you look at the amount of tax revenue that's collected in Ireland and you divide that by the Irish population, I think these days it's something like almost 4,000 euros per person. Meaning it's equivalent for a family of 4 to $16,000, 16,000 euros in corporate tax revenue. That's 10 times more than the US or Germany or relatively high tax countries. So the point is that tax competition works really well for small economies that choose very low tax rates, because by choosing very low tax rate, they can attract a lot of profits, a lot of activity sometimes from the rest of the world, and they benefit from it. The problem is that I don't think it is a sustainable development path for those countries. And why isn't it a sustainable development path? It's not sustainable because it really depends on whether the other countries are going to tolerate it, to tolerate tax competition. If they do, then okay, it can work. But those other countries, they choose to tolerate this, and they could choose to do differently. They could choose to collect those tax deficits that I was mentioning. And the day when other countries, the US or others, decide to stop, to end the race to the bottom, to stop tax competition, then the development model of countries like Ireland will be dramatically weakened. And so in the short run, it can work, but in the long run, I think it's very risky, and it's very likely that this will actually fail those countries.
So I think we have time for maybe one more question. Yes. Yeah, go.
Okay, I hear what you're saying about taxation could be a lot more equitable. What's the end game? Is it paying down the deficit? Is it funding the future? Is it a both and? That's where I'm in trouble, right? We're mortgaging the future, and we're not paying, in my opinion, social safety net, physical infrastructure. But what would be the end game for more equitably collecting taxes?
Yeah, that's a great question. I'd say a couple of things. Number one is that a fundamental function of the tax system is to regulate inequality. And that's not very well understood, even though something that US policymakers used to understand very well and to implement, from the 1930s to 1970s, when you had very, very high top marginal income tax rate, 70%, 94%, during World War II in the 50s and 60s. The idea was you use the tax system to, regulate how much income and wealth concentration there can be in the economy. So that's one function. And, if we care about inequality for the reasons that we discussed that have to do with political power and so forth, then you can use the tax system very effectively. What the US experience shows is that tax progressivity has a big effect on inequality. When the tax system was the most progressive, which is in the post-World War II decades, that's also when income and wealth concentration was at its historical nadir. And vice versa, today that income and wealth inequality has been rising a lot over the last few decades. That's largely related to the decline in tax progressivity. That's one thing. The second thing is I think the answer to your question very much depends on the country. So the US, it's important to keep in mind that the US is a relatively low tax country. Among high income, OECD countries, if you look at the tax to GDP ratio, it's really low in the US, like 28%, 30%, much less than the rates that we observe pretty much everywhere else. And what that means is that, what that reflects is that just the social safety nets and the social state in the US is very incomplete. Obviously, millions of Americans don't have health care. Many millions have very limited, if they have private health insurance, it's very limited, and so on. There's underinvestment in many parts of the education system, and so on and so on. And so in a country like the US, I would say a top priority is really to collect more revenue to complete the social state, the welfare state that's really underdeveloped compared to what's done in the rest of the world, especially high-income countries. Yeah, that's it.
Okay, I'm afraid we're out of time. Thank you so much, Gabriel, for your participation, for coming here. Thank you for the Berggruen Institute for their partnership, and thank you to the attendees for coming. And I've been asked to announce that the Possible World series will continue in May next year.